when Zoom had sort of jumped from $20 to 80, I was looking at it thinking, oh, well, that's fair. That's the trade of this month. It was May 2020. And I thought, well, good on the people who got into that. That was sharp. That trade is clearly past now. And then I went to 500. And I was like, wow, if you just look at a chart that's gone up fourfold in 2 months, you can't ever think like, tell you what, I reckon she's a buy. But it was. And then they obviously got way overexcited. And the pullback comes. And I think, it's a little microcosm of an entire investment cycle. There are reasons to invest. There are reasons why it should be worth $80 instead of 20. There probably aren't reasons why it's worth 590. But that's where.
Welcome to the Exponential Investor Podcast. Want to be a better, smarter, more clued up investor? Well, you've come to the right place. We cover the breakthrough investment ideas you don't hear about in the mainstream to keep you on top of the megatrends and opportunities reshaping our world. Good morning. Welcome to the Exponential Investor Podcast. I'm your editor, Sam Volkering, here with my co-editor, Kit Winder. Unfortunately, due to some technical difficulties today, you can only see me and not Kit. I don't know if that's a good thing. It depends on your view of each of us. But anyway, thanks for joining.
Get on with it.
Thanks for joining me, Kit. What's caught your attention this week in the market?
There's not a huge amount going on.
It's not actually this week, is there?
No, you asked me that question quite a lot, and I suppose I've been trying to sort of zoom out and think, what are the big themes? People thought bond yields and interest rates were going to be going up, and they got to like the US 10-year got to like 1.6, 1.7, and then has just gently fallen back. And then a few of the old things have continued. So there was a bit of a value rally that's fizzled out. Don't really see that changing anytime soon. America's pulled out of Afghanistan. That doesn't really have huge market implications, except reminding people how quickly things can fall apart. Just sort of, the fangs keep getting bigger again. We had 3 months off going on about how much Facebook, Apple, Amazon, Netflix, and Google go up, and now they're back. So we can keep going on about that again if you like.
Well, I do have a question I'd like to get your take on, sort of around that. This isn't one of the fangs, but it's certainly one of the hot stocks of the last year and a half. One of the COVID stocks, I guess you would probably call it, and that's Zoom, and companies like Zoom, I suppose, that really exploded when all of a sudden everyone was confined, and still very much, for a lot of people are confined to the house, which means a lot of Zoom meetings, which means a lot of businesses subscribing, taking out Zoom plans and the like. However, I saw an interesting article this week on Zero Hedge. For anyone that is watching, listening to this, I know, Kit, you visited as well, and a number of our editors do. Zero Hedge is a great site for just a good mishmash of things that are going on in the world, from the good, the bad, the ugly, and the funny. But I saw an article on there that said that 25% of bosses had admitted to firing somebody due to Zoom gaffes. Basically, somebody on a Zoom meeting doing something that they shouldn't have, or behaving or performing in a way that they shouldn't have, resulting in their termination. And I don't know. I just found that weirdly amusing that Zoom meetings have become now, and the Zoom gaffes have become quite the thing, and are actually resulting now, obviously, in people getting fired. And then it sort of made me question: is the hype around Zoom, has it come off? Is Zoom one of those stocks that really was all about the situation at the time, or is there still, are we shifting to this new normal of where, Zoom meetings are very much a part of our life? I mean, we're doing this via Ring Central, which I'm not 100% sure of the affiliation with Zoom, but it's very similar technology nonetheless. But I had a look at the Zoom stock, right? And if I go back to my chart here and I look at the 52-week range of Zoom, it hit a high of $588.84, going back to sort of late last year. Currently trading at 290 US dollars. So it has peeled off a huge amount of that rise. Now, I will also add it's up from like $80 a year ago. Sorry, $80 about 2 years ago now. So it's still, up a big whack, but it's really peeled off those highs. I guess my question for you is, what when it comes to these kinds of COVID stocks, which really did boom from COVID. There's no doubt. If we hadn't experienced the last 18 months with the pandemic and everything, I very much doubt that Zoom would have got anywhere near $588. So I guess my question is that are these the stocks that investors still should be kind of looking at and considering? Is there a new normal coming, or is it now we've kind of come off that hump, and perhaps that these attention grabbers aren't necessarily the greatest thing for people to be considering anymore?
Yeah, I mean, it's a funny one, isn't it? People get overexcited. But the psychology around this stuff I always find very interesting. I wrote a piece a while back around how when Zoom had sort of jumped from $20 to 80, I was looking at it thinking, oh, well, that's fair. That's the trade of this month. It was May 2020. And I thought, well, good on the people who got into that. That was sharp. That trade is clearly past now. And then I went to 500. And I was like, wow. If you just look at a chart that's gone up fourfold in 2 months, you can't ever think like, tell you what, I reckon she's a buy. But it was. And then they obviously got way overexcited. And the pullback comes. And I think, it's a little microcosm of an entire investment cycle. There are reasons to invest. There are reasons why it should be worth $80 instead of 20. There probably aren't reasons why it's worth 590. But that's where market psychology takes over from market fundamentals. And so now it's sort of returned to, I mean, actually it's in the ether. I think probably it's pretty unclear what a reasonable fair price for something like Zoom is at the moment. As you say, well, the future is always uncertain, but like, it's quite a binary option. Like, do people go back to the office or do they not? Zoom is only successful in one of those. And I thought it was interesting. Like business travel, I think was always the big argument. And we as a company, we didn't do a huge amount of it. But do you have a sense from other companies? Like, are they, well, anecdotally, I've heard of people, mainly in the sort of sales or client related space for their respective companies, saying it's unbelievable how much better things are going now that we're allowed to go and like take people out for drinks and dinners, take them to the 100, to golf days, whatever it is. The change in the performance of those sales divisions has been dramatic. And I'm always sort of the belief that we're in the office for a reason. I've been thinking lately, like, 18 months is a long time to be detached from your colleagues, from the enterprise of your enterprise, and sort of being in there all together. So my suspicions are that it might take longer than a few months, but that we'll slowly go back to how things were, because they were like that for a reason. We weren't just there because, oh, well, we've just always done them, whatever. Like, there are very good reasons to be in an office.
Yep. Yeah, absolutely. And I think you make a good point there, right? So I certainly get the feeling from everyone I speak to that things like you say, like business travel and business entertainment, things like that, are certainly will rebound very hard as soon as those shackles are unleashed, and we're starting to see that already now. Here in the UK, is that those restrictions are being shaken loose. It's a little bit trickier for international business travel, but there's certainly a huge amount of pent up demand for that I think will be ready to explode. And like you say as well, I think that that we will see a very speedy return to what we are very much used to. And for me, it there are pockets of industry, I think, which have forever been changed. I think healthcare is one of those where new technologies, it's accelerated the use of new technologies, and we will forever see that now as the new normal. But I think with certainly when it comes to enterprise and the idea of an office environment, and people commuting to an office location, I think that will return. I think it will return fast. And so my view is that a lot of these lockdown stocks, these COVID stocks that facilitated a very important function and purpose during this period, this abnormal, it should be said, very abnormal period. It's very unusual and uncommon for events like this to take place over such a long period of time. So while relevant and certainly, they made hay while the sun shone, figuratively speaking, on them. I think that the flip side of that is that all of a sudden you will perhaps look to find pockets of industry that will benefit from that return to normal, whether it be, office services, building maintenance services, companies, all those integral parts of how a city, an office environment functions, that continued progress towards, smart environments within buildings and within cities about how they manage people and traffic and the environment and all those aspects. I think that's where we'll start to probably see the next wave of how this pandemic comes off and that return to normal comes in. So certainly and this is sort of the process, I think that it's important that people watching and listening understand that we go through, is that when we see something like Zoom, for instance, and the situation around the pandemic, and we see a stock like that dramatically rise, but then also peel off a lot of those gains, the thought process certainly for me is, well, what does that mean for not just that stock or that sort of area of opportunity, but where's the next one coming from? And if we do have that shift back to, as I say, more normal, inverted commas, situation, then it opens the door again for a whole bunch of industries that were hit really hard when people weren't going into an office. So I think that's certainly an area. Those are the sorts of processes that investors should be taking with their mindset about investment ideas and the process and thesis that they build for what's coming. But it's still very it changes a lot from country to country. As a lot of our brethren back in Australia are still under reasonably strict conditions as to where and what they can do. So companies that might have exposure to Australia are going to fare differently from those that might have exposure to the UK, Europe, America, and so forth. So again, it's very interchangeable, the conditions. It feels like you've got to be ready to be nimble and to move in, out of something if it turns against you because of geopolitical moves or policies or clampdowns or anything like that. So again, it's it's all fun and games, I guess. But that's how I see that sector playing out.
Yeah, I mean, the Australia point is a really interesting one. Like, sorry, excuse me, because at some point there has to be a serious, policy risk attached to pretty much all Australian exporting companies or importing companies, or all Australian companies who are struggling to hire international talent at their home offices, right? I mean, if we don't see a sort of change in the tone or the suggestion of how they're going to approach things in the future, if Australia and New Zealand are going to be doing this for the next 5 years while everyone else has moved in a different direction, rightly or wrongly, they're worth less.
Yeah, absolutely. I think that's absolutely a factor that, and because so many companies are still very much multinational with offices or with clients or customers in places like Australia, which is it's just a very important market for a lot of businesses. And so it's absolutely important to understand, for investors to understand just where their companies that they're investing in actually get their money from, where they make their revenues from, where their profit centers are, and understanding the situation in those places and factoring that into their investment decisions. So yeah, you're absolutely right. It's because it is such an interchangeable world at the moment. The depth of knowledge about the investments that you've got in your portfolio, about where and what they do exactly, has never probably been, I don't think, as important as it is today. I mean, it's always important, but knowing your companies inside out not just if they're a meme or not, is the flavor of the day. But anyway, we've gone on long enough. We like to keep this podcast nice and brief and short so that we don't bore you to tears on a Friday morning. Anything else that you'd like to add or quickly bring in before we wrap up today's episode, Kit?
Yeah, only just to keep an eye on this Chinese property company. I don't know if you've been looking at this, but the property company Evergrande, which is a very, very large Chinese property company. There's been a theme over the last few years of people looking at how much has been built in China, sort of as a GDP creation exercise, in terms of things that are going to be built and not really filled. And that Evergrande is one of the largest companies, and it's issued a warning, I think, last Tuesday saying we're in serious risk of default if we can't raise cash, and it kind of came out of nowhere. And its bonds are now trading 27 cents on the dollar. Its EV business is down 80% this year. They're trying to sell it, but they can't. Hasn't sold a single car yet. That is, if that goes bankrupt, that is a really bad sign for the other ones, because it came out of nowhere and there was no real sort of indication that it was struggling beforehand. And B, as we know, one company defaulting in a sector that people are very concerned at in terms of liquidity, Bear Stearns, can have serious knock-on effects for the rest of a significantly over-levered business. And the Chinese government has tried to sort of de-lever it, which is probably what is causing this. So keep an eye on Evergrande in China.
Yeah, interesting you point that out. I saw a fascinating chart earlier this week as well about the divergence of the Chinese and US market. And it was literally like the US market has just continued higher and the Chinese market has just taken a hard turn right and headed south, with a divergence that has never before been seen on such a scale, which is a slightly frightening.
Yeah, I mean, specifically to do with tech as well. And I think the point we make there is that Chinese government has cracked down on technology and education stocks. And we were just mentioning, is there a political risk in Australia? This reminds you that political risk is a very real factor in investment. Everyone just sort of thinks companies are companies, sod the jurisdiction. But if a government turns hard in a direction, it can have a very material impact on the performance of the companies. And yeah, as you say, Chinese tech is a powerful example. Have a look for those charts if you haven't seen them. Just look up sort of, what is it, QEB, the Chinese tech in Hong Kong tech index versus the Nasdaq. It's quite extraordinary, actually.
Yeah, and probably also a reminder that with positions that do take a turn for worse, you've got to sometimes look at them and really assess, right, should I just get out of this and just let the dust settle and see what it is? A lot of people just try and catch a falling knife and double down and end up in a sticky situation. But that political risk is absolutely a major factor. Again, super prevalent today for all investors to take note of. But as I say, anyway, we've gone along. We might explore the China thing a little bit more next week and dive a bit deeper into what that could mean and how to play it for investors. But thanks again for tuning in. Hope you're enjoying our regular Exponential Investor podcast. We'll be back with you again, as I say, next week. Thanks for tuning in, and bye for now.